coming up later today, we're getting the minutes. Now, we already know some details here. We know we have a divided Fed, 3 dissents, 2 said just pause, 1 person said 50 basis point cut. We know they're trying to weigh the impact of inflation and weakness in the labor market. Is there anything in this minutes report coming up later today that can change your view on either the market today or the Fed in 2026?
I kind of doubt it. You know, Frank, we were here yesterday, and I remember talking to you about signal versus noise, and I feel like the minutes are going to be a lot of noise because of all of that dissension, frankly, on both sides, and because the things that caused that dissension have not cleared up in the last few weeks, and they're not going to clear up probably for a couple of months yet. Those items being things like how much is the labor market weakening, and where is inflation and the effect on tariffs. I do think that the Fed is going to be wise to pause here. For how long we need to see, but certainly the next meeting, I don't think they should be going. Let's get another couple months worth of inflation data and jobs data. By the way, we talked about this yesterday too, but I continue to think this is very important. When the Supreme Court rules on the legality of the tariffs as they're currently enacted, that's going to put a lot of things into an uproar. That may change the inflation numbers if tariffs are at least temporarily ruled illegal. The president will, of course, use different statutes. But things are going to be up in the air, and I think with the amount of easing that the Fed has done over the last year and a half, they have the luxury now of waiting, and they should take that luxury.
All right, Jason Snipe, when we're waiting for these Fed minutes to come out in the build-up to it, is there anything you're anticipating, anything you want to look at when it comes to these Fed minutes, or anything about the Fed that you think this could at least potentially clarify?
I don't think so, Frank. I echo a lot of Jim's sentiments, and Frank, you already said it at the top, right? 3 dissents. The Fed's never been more divided, well, at least in the last 6 years, let me say that. For me, I think the focus for the Fed clearly is labor. That is the concern for them. It'd be interesting to see if there's some commentary about inflation, right? I know that it's obviously been a dual mandate for years, but they have definitely veered off into the labor department. We know labor is solved, so I don't expect anything earth-shattering in terms of the minutes, but my focus is kind of going into 2026. I think directionally we're still heading lower. There will not be a cut in January, but I think that with the Fed share shift happening in May, looking into the back half of the year, I think that's the focus for me in terms of where policy goes.
All right, Josh, same question for you. Anything in these minutes that's potential to change your view of the market right now, the Fed in 2026, 2 cuts priced in as of right now?
The Fed is the least important chess piece on the board right now. Out of all of the things that are driving markets globally, not just in the U.S., literally the Fed is the least important. Not because the Fed isn't powerful or because we want to fight the Fed. It's just that you're looking at a 16% chance of a cut. That could go to 0 the next time we get a hotter than expected print on something. It could also double to, a 32 or a 40% chance the next time we get something disappointing on the labor front. But the reality is this has just been an incredible year for asset owners around the world. It's so much bigger than just whatever the FOMC is going to do. And the reason why what I'm saying I think is important is because the momentum is probably not going to stop on a dime just because the calendar turns over from December 31st into January. I want you to consider the top 3 performing sectors this year. Communication services stocks are up 34%. Tech up 25, industrials up 20. Not far behind are financials. You just take those 4 sectors, that is a huge chunk of the market. There are, I think, 13 or 14 S&P 500 stocks that have gone up more than 100% this year. But then you look at other asset classes away from the S&P, and you realize that what's happening here is so much bigger. Europe is up 36% year to date. International emerging market stocks up 34%. International developed is up 32%. Brazil's up 50%. Canada up 37%. That's not the Fed. It's nothing to do with it. In fact, in Japan, they had 2 rate hikes this year, and the stock market broke like a 4-decade high. Gold is up 65%. The commodity index is up 20%. The ag is up 7%. Tips are up 7%. Even cash is up. The only thing I could find that's down is Bitcoin. So we're not talking about when's the next 25 basis point cut. What we're really talking about is a wealth creation atmosphere of enormous magnitude. A lot of people have been underweight. They haven't been involved in international, or they've forgotten how to buy things that aren't S&P 500. And I think that should really be investors' focus for this coming year. What do I own? Do I own enough of it? Is it meaningfully diversified? And does it have an opportunity to outperform in an environment where the S&P is selling at 22 times earnings?
All right, Josh, we're going to talk a lot more about that broadening coming up just a bit in the show, but you're saying the Fed is the least important piece on the chessboard. I'm going to go to the chess master in this case, our Steve Leisman, to talk about these minutes coming up. Steve, what are your expectations? We know about the dissension in the Fed. We know that the issues that they're trying to weigh, it's labor and it's inflation. What are we going to learn today?
I just want to use the term en passant just to really show my how much I know about chess, Frank. But look, Jim said, wait for the data. Josh said the Fed doesn't matter very much right now. And I kind of agree with both. Let me see if I can put it together, which is this notion of waiting for the data. I think that's one of the reasons why the probabilities for January are so low, why it's a 50-50 slot or probability for March, because we don't really have a clear picture. And if the outlook remains, Frank, the way we think it is, which is that inflation either is stagnant or starts to come down, the job market remains somewhat weak, then I think we understand the direction of travel. And that makes Josh right, which is that in that context of a Fed that's either sticking where it's at or possibly lowering rates over the next several months, then that's not something the market has to worry very much about. The danger becomes if we do wait for the data and we get a picture of the economy that's different from the one we thought. In other words, a surprise on inflation, a surprise on growth or employment, then I think Josh would be wrong and we would have to care about the Fed.
All right. Coming up next year, not only are we expecting to get the president announce his pick for the new Fed chair. Remember, Jay Powell, not remember you, I know you know, but Jay Powell's the chair up until May. But we also get 4 new voting members. The Cleveland president, Beth Hammack, you did a great interview with her just a few weeks ago. Neil Kashkari in Minneapolis, Lori Logan in Dallas, Anna Paulson in Philadelphia. Are any of these people, are they likely to change kind of the, the texture of the FOMC and come with a different point of view than what we're expecting to see in these minutes?
I don't think so, Frank. And I think one of the reasons is getting back to what Jim said, wait for the data. Look, Hammack and Logan have been a little bit more hawkish. Kashkari maybe a little bit more like them, not quite as hawkish. Paulson a little bit more dovish. John Williams, I interviewed not too long ago. He sees rates coming down. Again, I'm going to come back to where Jim started. And the big unknown for next year is just what is this economy doing right now? You have this conflict between strong GDP growth and weak labor market growth, and that could be joined or solved by the issue of productivity. If that ends up being right and a big story for 2026, the Fed can cut into that process. And I don't think that people like Hammack and Logan are going to stand in the way of that if you don't have inflation as a problem. The real issue, the real divide is how big a deal is 3% inflation. Well, if it starts to come down, it's not a big deal. And if the job market remains weak, that clears the way, gives the Fed a green light for cutting rates. If it goes the other way, Frank, it can't be understated how difficult it is for the Fed right now. And by the way, economists on Wall Street as well. Now, the easy thing to do, which is what I think Josh is focused on, is the outlook for earnings. That remains positive. And if the economy remains in good shape, then those forecasts for better earnings, that's the real key for investors, I'd say.
All right, our Steve Leisman live in D.C. Steve, I know you're going to have those Fed minutes coming up later today. It's good to see you as always. Thank you very much.